On that note, here are the equity calls for the morning. This is what the wise experts have to say as we look at Friday. Neelkanth Misra of Credit Suisse says if there were no further rate cuts, real rates would stay elevated till the end of forecast period. Bond yields did not respond to the cut due to fears of fiscal slippage and as the RBI refrained from committing to continuing bond purchases. But the term premium has again crossed 100 basis points. Further cuts would bring the yields down. The change in risk weights for bank loans to NBFCs from a mandatory 100% to a ratings-based weightage affects firms adding up to less than a third of overall NBFC borrowings, as several large categories were already eligible. It may free up to 1.6 lakh crores of risk-weighted assets for banks. The impact on NBFC loan rates and volumes may be marginal. So there we go. We have some clarity. CSU coming in on what the NBFC development would mean.
You have to keep less capital to give loans to some NBFCs. That capital is available. That doesn't mean they're going to use it to give more loans to more NBFCs. Banks may be risk averse. So that relief in capital need not translate to more liquidity for the system. That we have to keep that in mind. Maybe that risk aversion is not there, and maybe good NBFCs like the Bazaar twins or the HDFCs of the world get more money. But it's not going to be a uniform availability of money or any ease of the debt markets problems. Okay, money market views for you. Bhaskar Panda of HDFC Bank says global growth fears reared its ugly head again after both ECB and Bank of England cut growth forecasts. Also, President Trump has said that he won't meet the Chinese premier before March 1st deadline for trade. Against this background, Bhaskar Panda expects that we may see a little weakening bias in the USD-INR market. He sees the range for the day at 71.40, 71.60.
Okay, well, on bonds, Bhaskar says yields reacted to the policy cut and benign inflation projections coming from the Reserve Bank yesterday. The 10-year benchmark yield could consolidate around the 7.5% mark. For the old 10-year benchmark yield, he's expecting the range for the day to be 7.47 to 7.53%.
That's a bit mild. Good.